So I just got off the Texas Roadhouse conference call for their full year 2019 results, which just came out today, although you'll be watching this tomorrow, so they came out yesterday. But in today's video, of course, I'm going to be breaking down their fourth quarter and full year results, and then we will go through my spreadsheet, update the numbers, and talk about what has changed in the past quarter. So how have their numbers changed from 2018 to 19, actually, and in the last quarter. See how their growth has changed, has my opinions on where the company can grow in the future, and what are my thoughts around the valuation of the company as well. If you enjoy these kinds of videos where I go ahead and break down the earnings and the conference call and that sort of thing for a particular company, then the best way that you can let me know is by hitting the like button or just leaving a comment, sharing your thoughts down in the comment section below. Both of those things show YouTube that you guys are enjoying the content, engaging with the content, whether that's leaving a comment or just liking the video. So any of those things really helps me out a ton. But for now, let's jump into the press release and start looking through some of the core numbers that came out for Texas Roadhouse for their full year and fourth quarter results. For the fourth quarter, total revenue came in at $725 million, which was up 19.7% year over year, which is fantastic. Net income came in at $42.6 million, which was up 40.7% year over year, which again, great result. And diluted earnings per share came in at 61 cents, which was up 45% year over year. But more importantly, for the full year picture, the company's revenues came in at $2.75 billion, which was up 12.2% year over year. Net income came in at $174.4 million, up 10.3% year over year. And earnings per share came in at $2.46, which was up 11.9% year over year. Now, there's a couple of things that are important to note straight away when we look at these numbers. So you would have noticed that revenue grew by about 12%. Net income grew by, or profit grew by about 10%. And then EPS, earnings per share, profit per share, came in at 11%. So why is there a discrepancy between those three numbers? Well, first of all, we can compare revenue to net income, or revenue to profit. And we saw that revenue grew at 12, but profit grew at about 10. And that is a result of their higher costs. So a big cost, a big sort of short-term event that has been happening with this company, a big reason why the stock price fell so much during the start of 2019, is because the industry, or pockets of the restaurant industry in the US, are experiencing higher labor inflation, which means the cost of labor, the cost of hiring entry-level employees has been going up. And those higher costs mean that less profit comes down at the end of the day as profit. Although, to be fair, there wasn't a significant impact. There was only about a 2% differentiation between their revenue growth and their profit growth. And then we can talk about why their earnings per share grew faster than their profit. Why did profit per share grow faster than the overall company profit? And that was a result of some share repurchases that the company did throughout the year. So during the year, the company repurchased 2,600,000 shares for about $139.8 million. Which means that they were able to repurchase a significant amount of their shares, which means when they repurchase shares, they get deleted. So you can imagine a pie cut into 8 pieces. If they buy back 2 shares, then there's now 6 pieces in that pie. So each piece gets a little bit bigger, meaning that the earnings per share gets a little bit bigger. But essentially, they were able to repurchase quite a significant amount of stock at an average price of about $53 per share, which is, interestingly enough, the price that I invested into this company, which I thought was quite funny. But essentially, $53 per share is significantly lower than where the stock is now. The stock is now, after hours, I'm not sure where it is when you're watching this, but straight after the earnings came out, the stock was trading at about $71 per share. So what that means is not only were they able to spend some money to delete some shares and increase the profit per share, but they have already made a significant return on deleting those shares. Because if they remove shares out and your piece gets bigger, and the stock price goes up in the future, then that means that you've double benefited. You've benefited from greater earnings per share because they've deleted shares, and your shares have gone up significantly in value. Now, when it comes to the restaurant industry specifically, there is really one key measure that is super important to follow, and that measure is called comparable store sales, or sometimes it's called same store sales. Every restaurant chain kind of has their own little name for it, but Texas Roadhouse calls it comparable store sales. And this basically compares the growth in sales from stores that already existed throughout the year. So sales for a restaurant business really come in two ways. Either they build more restaurants and therefore they have more restaurants available to generate revenue, or their existing restaurants grow their sales. And comparable sales looks at those existing restaurants and sees what their sales growth has been. And this is super important because if there is sales growth in restaurants that have already existed, it tells us that more people are coming back and more people are spending more money at these restaurants, and that is a strong indication of a competitive advantage. So we want to see that this number is consistently above the industry average, which is usually about 2 or 3%. So for Texas Roadhouse in 2019, comparable restaurant sales increased 4.7% at company restaurants and 3.8% at domestic franchise restaurants. So a 4 to 4.5% increase in comparable store sales is excellent. It's pretty much in line with what this company has been seeing over the past few years, although there's been some years where they've had really, really high comparable store sales, such as 8% or something like that. But it's a great sign to see that they're not seeing a substantial drop in their comparable store sales, even though they had a really tough year. So excellent sign so far, nothing really to complain about their earnings so far. One other thing to mention is that they opened 22 company restaurants throughout the year, which included 3 Bubba's 33 branded restaurants and 9 primarily international franchise restaurants were opened. So let's now jump over to my spreadsheets and enter in the new data and make some comparisons between the growth in the spreadsheet from 2018 backwards and now since we have the new year, and see if they are in line with what my expectations were for their growth, and see if their business is sort of more or less on track to return to me the cash that I was expecting when I initially made an investment about 6 months ago. All right, so here is my spreadsheet from last year when I did the latest year, which was 2018. For those who are wondering why I haven't filled out operating cash flow and capital expenditure, I just calculated cash flow for owners in another spreadsheet and I ported it over into this one. So because I had already done the numbers before I'd updated this spreadsheet, so that's why it looks like that. But other than that, these numbers they should all be the same. But you can see that in 2018, they did about 280 million in cash flow for owners. And you can see there are other numbers here, which we spoke about, how they had about 12% growth in the top line. I think about 11% growth in terms of earnings per share. And we didn't actually speak about equity, but we will now. So if we jump over to the new spreadsheet, you can see that we've entered in that number, that one. We can see that equity actually declined. And typically, we want to see equity growing over time, but it is normal to see equity decline when a company is repurchasing stock. So if a business you're looking at is having a really bad year, and as a result, management has decided that they want to buy back stock because they think they can get it cheaper, and that the stock's going to go up over the long term, then this is typically what you will see. In terms of cash flow for owners in 2019, we actually cannot calculate this number yet because we are waiting for the annual report to come out. We only have the press release, which gives us some of the summary numbers, the highlights of the year and the quarter, but we don't have the detailed numbers about their maintenance capital expenditure. But from some of the reading that I've done and making some assumptions about how many restaurants they opened and that sort of thing, I come to the conclusion that their cash flow for owners is going to be more or less the same as it was last year. So even though they grew their revenues, they had higher costs in terms of cash, which meant that their cash flow for owners actually probably won't grow in 2019. So from there, we can take a look at their new growth numbers. We can see that as we saw, sales grew at 12%, earnings per share at just under 12%, equity declined. But again, I'm not concerned about this because it turned out that it was a good time for them to buy back their own stock. They repurchased stock at $53 per share, and the stock is currently trading in after hours at about $71 per share. So they've made a substantial return on the stock that they repurchased, even just over the past 6 months. So I'm happy with that decision. And then in terms of cash flow, it looks like their cash flow will be about flat. But with that year taken into account, you can see that their long-term cash flow is still growing at over 12%, which is excellent. Equity, you can see, has slowed down in terms of growth. Previously, it was at about 9%, and now it's dropped down to about 7%. But again, I'm not concerned because they spent company cash in order to reduce the number of shares outstanding, which means that their book value per share and the intrinsic value per share, I should say, over the long term will increase as long as I think they made a good decision. And considering I bought the stock at the same price as what they were repurchasing stock at, I clearly think that they made the right decision. And sales growth, earnings per share growth, still very much on track. So what we can talk about is some of the models, I guess. And since their cash flow didn't really change in that year, the starting cash flow isn't going to change really at all. So what we really need to consider is, do we need to lower the growth numbers that we're using now that we are 12 months forward in this investment? Or for me, it's 6 months, but we're 1 year into this investment. Do we think that their growth is going to slow down? And I am still happy with the growth numbers estimations that I've got in here. I think that the 0% growth rates with the average cash flow and the 2019 cash flow, I think those are extremely conservative, and I think it would be very unlikely that that is something that happens for this company. And if we come over to intrinsic value for those models, we can see that even if they don't grow, they're likely going to return somewhere between $3 and $5 billion per share, which I believe the current stock price is about 4.6. So basically what I'm suggesting with these models is that you would at least get your money back even if they grew at 0%. But I think these last three models are much more likely going to take place, meaning that I think that their intrinsic value range is somewhere between $7 and $12 billion for the entire company, representing maybe somewhere between a 2 to 3x from this point. And then we can see that translate into a buy price per share, buy price for the whole company, and then buy price per share if we're targeting 22%, which the buy price is substantially lower than the current stock price. And when I purchased the stock, I actually didn't wait for a 22% return. I was more in line with something like a 12% return for this middle model, which I think this middle model is super conservative. So if I'm investing and assuming a 5% growth rate, and I can expect a 12% return on that 5% growth, I'm feeling very confident because I think they can definitely outperform that, meaning that I think investing at that price at $47 per share or around $45 to $55 per share will at least generate around a 10 to 15% return, which is what I was happy with at the time because I had too much cash and there was no other stocks that were offering me a return any higher than that. This was the best opportunity I could see. And on top of that, the short-term effects that they were experiencing, which was really labor cost inflation, I didn't expect that to last more than about 12 months. And the stock had already fallen, I think, 30 or 40%. So I felt as though it was very unlikely we were going to see this stock fall any further in the next year. So I took the opportunity to buy a small position in the stock. Well, it wasn't super small. It's the second biggest position in my portfolio, but it's certainly a substantially smaller position than something like Thor Industries, which represents about 20 or 25% of my portfolio. But at the current time, the stock price is looking like it's at about $70 per share. So if you're assuming that middle model to be conservative, it looks as though you're going to be looking at something like a 7% return. So the return has dropped substantially over the past 6 months. I think the stock's up about 50%. So a big chunk of the return you would have made on Thor Industries over the long term may have already happened. So I'm happy that I got into the stock, but I honestly would have loved for it to continue to fall so that I could have purchased it with a 15% return, for example, with that middle model. Again, I think that middle model is very conservative, so I think the margin of safety is within that 5% growth rate. The fact that I'm not assuming 8 or 12%. So if I could have got the stock, if I could have bought some more stock at $39 per share, I would have loved to, but unfortunately that wasn't the case. And yeah, doesn't really matter from now. We will see if the stock goes up or down from here. So I hope you guys enjoyed this video. And as I mentioned at the beginning of the video, if this kind of thing is something you like to see, I have a feeling it is, because these videos generally do very well. But if it is something that you would like to see, then the best way you can let me know is by doing one of three things. Hit subscribe if you haven't already and you want to see more content like this. Hit the like button, that lets YouTube know that you liked the content, of course. Or you can just leave a comment down below letting me know your thoughts. And if you have any questions about this or about investing in general, then I'll be answering questions down in the comment section below after this video goes live. So if you're watching this just as the video goes live, then make sure you rush down and leave a comment, and I'll be answering comments for you down there. But thanks everyone for watching, and I'll see you guys in the next video.